to you. Today is Tuesday, the 10th of February 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Yesterday, I talked about premium pricing and the brand as an asset. And today is what kills premium stories when they are not backed by Runway, which is a capital structure. So through the assets lens, so today I'm going to focus in funding assets. So it's not the how much cash do we have. It is, can we finance the plan at the right time, on acceptable terms, and without breaking trust with the market? Because at the end, you want to make sure your suppliers, your customers, your investors, and your teams still trust in your company, your brand. So let's take a look at three problems with the capital structure funding assets from the asset point of view. Problem number one, if your funding is reactive, the market sets your timetable, not you. That is when dilution spikes and credibility drops. And problem number two is that the UK interest rate conditions change the mood very fast. So boards that assume yesterday funding window will still be open next quarter. I mean, the funding capability, but the risk getting caught in a different scenario is very high. So stress test the plans against worse rates, less availability, and slower times in terms of funding. And problem number three is asset-rich cash pool. And I'll give you a good example. London Stock Exchange company that I'm watching disclosed a 12-month funding gap, reliance on equity funding, and potential asset sales. So despite having valuable holdings. So that is what asset-rich and cash pool looks like in board terms. In other words, imagine this. A strategy without a runway is a plan running out of fuel mid-journey. And the flight plan could be absolutely fantastic and excellent, but the plane will still drops. And by the way, this is nothing that I made up. It's a real story. I took it from a 1983 Air Canada plane that had to glide from 12,500 meters to an Air Force runway on emergency landing. And you know why? Because they confused the metrics from gallons to liters. So they put less fuel into, or less Jet 1 fuel into the plane than they should. So even the best plans can fail with very, very minimal details. So what does a board do in these cases when you have a magnificent plant and you're running out of fuel? You stop treating capital structure as a finance work stream. You treat this as a strategic asset that must be designed. And this is happening before that eventuality happens. So you have to do it before. So it's a finance work stream, a strategic asset that must be designed. So as a board advisor, what I would propose to consider in this case, number one, so make solvency and liquidity risk board visible, not the finance visible. So the Financial Reporting Council going concern guidance is built for exactly this: stress, scenarios, and clarity on triggers. So suggestion number two, align your funding plan to your market rulebook. For alternative investment market companies, the rules shape disclosures, timelines, and what order it looks like when you raise capital. So you have a rule book already that you can copy and paste or utilize as part of your game plan. And it's in the public domain. And number three is a build optional funding path that reduces single point dependencies. So what in practice look like is a mix of revenue, timing, partnership, stage investments, and non-core asset decisions. So the aim is a plan in which failing one funding route does not collapse the whole strategy, right? So, like the airplane, the plane that run out of fuel, so they have very alternative other runways that they could make an emergency landing. So here's a board level model you can use in 10 minutes or less. So I'll give you some practicalities here. Three columns, 1, 2, and 3. Column number 1, What must be true for the strategy to progress in the next 12 months? And here you have to be specific. Approvals, hires, product milestones, customer conversions. In column number 2, what cash profile those milestones require. So budgets, what triggers, the cash needs to land on why, etc. So you have here all the conditions. And number 3, the funding option map to confidence and control. So confidence means the probability of landing on time, and control means how much it costs in dilution, covenants, or strategic constraints. So when you do this, you see the hidden sabotage. For many boards, the preferred funding path has the lowest confidence and the highest dependency. So that is not really a plan, it's a hope. So why this matter then? Why the 3-column model approach matter? For 3 things: the outcomes, the differentiators, and the risk reductions. So in terms of outcomes, you reduce a one-page, or you produce a one-page funding asset map that shows runway triggers and funding options in form that boards can actually govern. So this is something that is governable. In terms of differentiator, you align the funding story to the disclosure rulebooks. And we mentioned the rulebook is in public domain already. So the market sees coherent rather than panic. So they will see that it's a process behind it. And actually, if that happens, you have your emergency plans, your stop loss, your moment where you say enough is enough, or we have to change the strategy here. And in terms of risk reducer, you pressure test a plan against UK governance expectations on risk and internal control, so you reduce surprises and credibility shocks. Again, your suppliers, your customers, your teams, your people, and your investors. So one action you can take home today, and it's doable in 30 minutes or less: build a one-page runway map with the 3 triggers: the best case, the base case, and the first stop doing optional spend point. So it's like the traffic light: green, yellow, and red. Now, let's pause it here for today and reconvene tomorrow, because if you remember yesterday, I mentioned premium pricing and brand assets. Today is the capital structure and funding. And tomorrow, I will show you how a portfolio and footprint assets stop your plan at a single fragile bottleneck. And surprise, surprise, you might have a very footprint asset plan, but it stops because there's one single bottleneck, and that happens all the time. So when you identify those bottlenecks, the earliest is the best to build alternatives and how to be more efficient, more profitable at the same time. So if you are a UK board member or in the executive team, and you want a B team looking at your funding asset plans and runway triggers, set up a 30-minute call with me, and I can understand your position and how an independent international advisory board looking from the outside in. So from the outside in, you are too close to the problems many times that you need a separate pair of eyes. Imagine a full international advisory board that can help you and your team without stepping on your toes, without the traditional consulting overhead, and without the public theater. So have a great day and see you tomorrow. Thank you and bye-bye.